Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. I am Ryan Nauman, the market strategist here at Zephyr. We know ETFs are exploding in popularity, and there are a lot of unique ETFs out there being launched, which have benefits and issues for financial advisors. Well, I have on the perfect guest to talk about using ETFs in portfolio construction and how to build portfolio strategies around some of these ETFs. But first, today's episode is sponsored by the award winning Zephyr, which helps investment professionals make more informed investment decisions. I'd like to give a very warm welcome to Christian Magoon. Christian is the CEO of Amplify ETFs. Christian, thank you so much for coming on the show. It's an honor to have you on. I'm really excited for this conversation. I love talking about portfolio construction, the different investment strategies out there. So it's going to be a great conversation. Can you please tell us a little bit more about yourself and Amplify ETFs?
Sure. Well, thanks, Ryan. It's good to be on the show and congratulations. And it's my first podcast coming from the shores of Lake Tahoe. Awesome location. I'm coming to you from Colorado, and Amplify ETFs is a ETF sponsor actually based in the Chicagoland area. We have a little over $10 billion of ETF assets and about 30 different ETFs.
Okay.
We have a lineup of core growth and income-oriented ETFs. About half of our assets are in income ETFs. And we also are known for some of our unique growth offerings, whether it's the first cybersecurity ETF, the first blockchain ETF, et cetera. We've done a lot of innovative things on the growth side. We continue to grow and launch products and have a few new products coming out even over the next month. So I've been in the ETF industry since 2005. Back in my early roots at Claymore ETFs, which eventually was acquired by Guggenheim ETFs,
Yeah.
which eventually was sold to Invesco ETFs. And Amplify ETFs has been around since 2016 when we launched our first products that year, including the first online retail ETF I buy, and today our largest ETF, the Amplify CWP Enhanced Dividend Income ETF, DEVO, which is widely known in the income community. So we continue to grow and have a lot of different solutions, and certainly timely to be able to talk to you right now as a lot's going on in the market.
Yep, fantastic. It's a good thing, Christian, that I think the only financial investment podcast on the shores of Lake Tahoe. So I don't have many competitors. So
Yeah, you've got the exclusive, and as I said, I'm willing to do the next episode on location with you.
let's do it. Let's do it. I'm getting more and more guests asked to do that. So we'll have to make it happen. Zephyr's Adjusted for Risk, Tahoe Summit, maybe in the
Go.
near future. Um, you brought up the uncertainty, macro uncertainty, market uncertainty, volatility. What's you and your team hearing from financial advisors regarding this uncertainty? Are they hitting the panic button? Not yet. Moving the cash? Or are they kind of still staying the course?
Yeah, it's a great question. We have a variety of people out in the field talking to advisors every day. And, what we're hearing is that advisors are starting to look at a little bit more tilt to quality exposure, given some of the uncertainties happening. We're recording this a day after the tariffs were announced.
Yep.
But there was some fear leading up to that, and I'm sure we'll talk about that later. But also some of the geopolitical tensions that are going around, as well as kind of what's going on with interest rates and fiscal policy. There's just a lot of uncertainty there. So we're hearing more that advisors are starting to look a little bit more towards quality. Those that are maybe more growth oriented are starting to dial back some of their concentrated exposure to Meg 7. Certainly, if you own Meg 7 this year, it's kind of been the detractor of performance
Yeah.
relative to the other 493 stocks. So there's been more volatility there. So advisors may be becoming more prudent in how they approach the growth allocation in their portfolios. Also seeing advisors being more open to other sources of total return besides capital appreciation. So, well, many people think, well, that's dividends. It's also option income. So using ETFs that have derivatives that harvest some of this increased volatility we're seeing in the marketplace and turn that volatility into income. Most equity investors, when they see volatility, unless they're dollar cost averaging in, it's kind of a scary thing for them. However, when you have an equity portfolio that writes covered calls or tactically writes covered calls on those underlying equities, you can actually harness volatility to your advantage and go out and get more of your total return from income. So those are just some of the areas. I guess maybe the last one I'll note is many advisors, just are frustrated with how much cash their clients have. I think we're at over 7 trillion, and probably events like the tariff kind of tantrum here that's happening are going to force more money into cash. And, many advisors are, seeing that their clients just aren't going to be able to likely achieve their goals by having so much in cash. So they're trying to figure out ways to give their clients cash-like returns, or returns that would be, closer to ultra short or cash, maybe plus a few hundred basis points. And give them the security of that, but also have them participate a little bit more in the marketplace. So that would be the final trend, I would say, is just that, trying to go out and get that cash kind of off the sidelines and become a more productive asset for retirees, for those that are saving for long-term goals.
Yeah, it's interesting you brought that up because it seems like we've been hearing about that for a long time about so much cash on the sidelines. And with all the volatility, it's going to be a hard conversation probably to get investors to go, start investing or putting their money to work, whether it is in short term, short duration, or short term treasuries or paper. But he also brought up the Mag 7. I just saw a graph, last year for the previous couple of years, it was like the Meg 7 way up here and the other 493 down here. It is completely flipped now. Now you've got the Meg 7 performance negative and the 493 keeping the market afloat. It's just it's amazing how quickly investor sentiment can change and drive market performance.
Yeah, for sure. And I think this is an important, point to make to financial advisors that, you could still stay in the technology space, but maybe you get out of things that are concentrated from an index methodology standpoint in these Mag 7, and instead maybe move to a more prudent weighting strategy, perhaps like an equal weighted technology strategy that, still gives you exposure to that long-term growth curve. Because I think we all know it's going to be there with artificial intelligence, robotics, digitization of many different types of markets, but perhaps, taking some of the concentrated bets off the table and instead just being kind of a less than market weight or equal weight to those names. And on the other side, on the cash side, I think there's some really interesting solutions now. Part of this tariff tantrum we're seeing is that there's a higher likelihood, or at least the market's pricing a higher likelihood of interest rate cuts. Well, if we start to see these rate cuts, there could be some very interesting bond kind of alternatives that would benefit if rates get cut, and even some unique products. We'll talk about it later, where you own treasuries, but you write a covered call against the treasury to produce an additional 1% income every month. That could yield 12 to 15% between option income and just collecting the income on the treasury. So there's, I think, a time for advisors to really prove their value here by digging into some of these different ETF strategies and getting maybe smarter exposure. I don't think it's necessarily working harder. It's really smarter given kind of the evolution of the markets, whether it's Meg 7 or interest rate cuts, or even kind of what's working now given this new tariff environment.
Yeah, that's a fantastic point. And it goes along with at the opening. It's like there's a lot of innovation in the ETF space. And that's a very good point about, these now new innovative ETFs are helping, are a great strategy for these portfolios to help mitigate some of this risk that's out there.
Yeah, for
Let's,
sure. And the
yeah,
risk hasn't been here for a while, right? This is the Today, as we're recording this, is like the worst drawdown since we've had single day. since 2022. So, risk hasn't been as much on people's mind. It's been more about concentrating, bets or exposure to things like the Mag 7, right? And that's paid off really well. So we've seen a gradual flip, and then all at once today with these tariffs. So this is just, I think, a really timely opportunity for advisors, especially as they probably are getting into their first quarter, end of quarter meetings here in the first month or two of the second quarter, to be looking at some of these solutions to address kind of challenges, because I think most of these kind of issues are going to be headline issues the next week or two to the Main Street type investors, and that's going to flow to advisors. And advisors are going to be getting the question, hey, what do we do about this? And again, we're going to talk about some solutions today. And there's other, tons of solutions in the ETF space that I think are very timely here that maybe weren't as apparent when, risk adjusted returns or volatility wasn't as high as it is today. I mean, VIX is up 25% today. There you go. You need to take a look at some of those risk type hedges out there, more so than what you did in 2024.
You're exactly correct. You talked some about some different strategies, portfolio construction strategies that help mitigate some risk. Are there other things that you and your team are focusing on that maybe financial advisors could leverage to mitigate some of this risk?
Yeah, well, we think that, making sure you're looking at rebalancing is quite important.
Okay.
There's a lot of advisors out there that maybe have let their winners run or didn't let their winners run and felt like they should have, given kind of the severe concentration we've seen in the market. So for the last couple of years, there has been concern about the Mag 7, yet they continue to dominate. And many advisors maybe were worn down a little bit on why are we selling off that to rebalance into the other 493. So we found that some advisors really haven't done as frequent rebalancing. So we think that's important. Also, looking at different asset classes. International stocks have been an underperformer for a long time, and yet this year they're really shining and standing out. And we're certainly seeing, our international funds see some, very attractive relative performance versus our domestic products, and we're seeing the flows there. And as we talk to advisors over the last couple of years about international, many advisors were just simply saying, "I already have international exposure via the S&P 500." We know about 50% of the revenue from S&P 500 companies comes from overseas. So, many advisors kind of just settled on that. And that frankly worked. However, we're seeing that disconnect this year, and there's more geopolitical kind of winds happening, whether that's fiscal and economic policy, geopolitical conflicts, even quantitative easing.
Yeah.
Germany's done some interesting things this year. So there's a lot of kind of cross currents, I think, presenting opportunities in international. So we're encouraging advisors to take a look at international again if they're kind of doing it via proxy on the S&P 500. That's clearly an area where they could improve alpha so far this year in 2025.
That's interesting. I'm really glad you brought that up because now for years it was like, does diversification really matter? Is it dead? What's going on? But it's a great case in point. You brought it up. Diversification does matter again.
For sure. I mean, and just in case of, looking at the numbers, international generally has a lower PE ratio than the US, but I think the last chart I saw is we're close to almost 5 standard deviations of the discount of the PE of international stocks versus US stocks. And, I guess looking backward, you can see over the last few years, international stocks, they don't have the Mag 7. We do. And that's really what set us apart. We also
Yeah.
have more exposure to technology than international. But now, kind of in this new world in 2025, you can see how kind of the opposite exposure is advantageous, and some of the concentration benefits the US have now turned into concentration risks. And that's why we're seeing that disconnect. So
Yeah.
some really exciting or attractive valuations internationally allows you to diversify, your markets as well as some of the policies affecting
Yeah.
markets. So I think it's a great time to take a look at it. And of course, we've got a few different options that allow you to do it with dividends and option income to kind of not just go all in on just capital appreciation. We also have a way to do it from a hedged exposure to own kind of a barbell of U.S. Treasuries and leap options on international stocks, which kind of gives you, a balanced approach, if you will, to international stocks. So a variety of tools out there, but definitely we think international makes a lot of sense this year.
Yeah. Yeah, I agree. I agree. And it just, especially if you brought it up at the beginning, quality is important. You brought up treasuries and stuff. You also brought up leap options. You know, one portfolio strategy or investment strategy during times of risk is really getting defensive, really, buying insurance, getting hedges. Um, if you're really concerned about a black swan event happening or a sell-off like we're experiencing today, are there other options out there that maybe where it's not a full on, you're just hedging for the worst? Are there other things that financial advisors could consider?
Yeah, yeah, for sure. So, there's tail risk hedge strategies that really only work during a severe decline and kind of deteriorate during, the majority of the time markets are rising. There's certainly buffer ETFs that really cap your downside, but also cap your upside in any given like 12-month period. But we know kind of over time that cap on the upside can be quite harmful to long-term equity returns. We've taken an entirely different approach, and we actually have a black swan suite of ETFs, SWAN, which is US, and iSwan, ISWN, which is international. And essentially, we've taken kind of the same type of investment strategy that the black swan concept indicates from the famous book, which is to really barbell the assets. And on one side of the barbell, have 90% of your portfolio invested in US Treasuries, and that's really your risk off portion. And then on the other side of the barbell, you own your equity exposure, so it's 10% of your portfolio, but you do it through leap options. And leap options give you that inherent leverage on equity returns. So only 10% of your portfolio being invested in that gives you roughly 40 to 50% of the upside of that equity asset class. So in our Swan portfolio, it's the S&P 500. In our iSwan portfolio, it's the EFA product. And what that does is it allows you to constantly participate in the equity markets while in times of crisis, allow you to have 90% of your portfolio in US Treasuries. So, like today's a great example where one day after the tariffs were declared, and we're seeing big drawdowns in the S&P 500, and our Swan product is up by several hundred basis points in terms of outperformance
Mm.
over the S&P 500. That type of alpha is magnificent, and on a day like this, accordingly, during general market conditions, you're not out of the game with that Swan strategy because you'll get about 40 to 50% of the return of the S&P plus Treasury income. So you're really, able to still participate. It's a great product for people who kind of want to sit on the fence. They're not overly bullish, they're not overly bearish, but they feel like there's kind of volatility on the horizon. It's a great complement to core holdings, either in the domestic space or in the international space. So our Black Swan suite is something worth checking out. It's been a while since we've had like a major decline like we've seen here post tariffs, and those products are definitely in demand and have been around going back previous to 2020, and they really shined, for example, during the short-term decline of 2020 initially during the COVID crisis. And we've seen other instances, shorter term sell-offs, where they've held up nicely too, but also didn't cap an investor's upside on equity participation artificially, and didn't and not work or decay during an upward moving equity market. So I think that's a great all-weather approach to
Okay.
having some form of hedge or protection, if you will, in the U.S. equity or international equity markets.
A great way maybe for financial advisors who are having an issue or trouble getting their clients to take some money off the sideline, maybe to get in a little bit slow, something that really limits that downside but gives them some upside potential. At Zephyr, we do a lot of research and analytics on, downside deviation, right? Because we feel, it's mostly me, I feel that really that's the true risk, not volatility, not so much standard deviation, but it's the drawdowns. the true risk of investing is losing your money. If you can, limit your drawdowns, but also, gain it, have exposure to equity so you can gain on the upside, that really can help you in your way to achieving your goals.
Yeah,
Really
yeah,
what
for
you said.
sure. Yeah, yeah, you're right on, Ryan. And it's, as a financial advisor, it's kind of a battle on with your clients on what they want versus what they need, right? And what they want is to not see, as much volatility, especially on the downside.
Yeah.
But what they need is long-term equity exposure to
Yeah.
achieve their goals, and you can't, get in and out of the market in time, and it doesn't work. So products like the Black Swan Suite kind of balance what investors want, but what also what they need. And we have other products too that maybe are a little bit more forward leaning on the equity
Okay.
side that aren't as treasury oriented, that maybe invest in high quality equities that are dividend payers, but also write option income on the underlying yeah,
Mhm.
single name stocks, essentially covered calls that do help to cushion or hedge during these market events where we see, breakdowns. And in upward moving markets, yeah, reduce some of your upside, but maybe for some investors, create a better blend of capital appreciation and income so that your total return isn't as capital appreciation oriented. It's more balanced between capital appreciation and dividend slash option income. And that would be like our Devo ETF here that's domestic focused in the US, or our iDevo ETF that focuses on the international side. And those are, leaders in their space. They fit into the
Okay.
derivative income category from a Morningstar standpoint, but really have added value to investors who are looking to have more equity participation in their core, but maybe are in need of a little bit more income. So those are unique solutions, and they're certainly holding up well today in the sell-off
Yeah.
relative to the S&P 500 or just the broad-based international index as well.
I'm glad you brought that because, one thing I always hear from advisors is they get these defensive names or investments that, might say they're black swan, but they're really defensive for times of crisis and they try and hold it long term, but they get frustrated when markets are up and it's like a drag on performance and they get frustrated. It's like insurance. You don't like paying for premiums until you actually need it, right? Then it comes in handy. But it sounds like products like your eight, there's still that upside potential where it's not a long-term drag on performance.
Yeah, we think that again, it's all about kind of what investors need and what they want, kind of blending those two. And we've looked at products that, for example, in the covered call space that have these very high yields. And when you look at them closely, they have very high yields, but their total return might be single digits. There's a famous uh, covered call product on the NASDAQ 100, and with yields of 11 or 12%, and then you look at their total return over 3 years and it's 4% a year. And we look at it and say, boy, that's not kind of the profile that we think investors and advisors want. And
Yeah.
we look at something like a Devo that historically yields around 5%, but maybe has a 3 or 4 year average total return in the double digits.
Yeah.
And we think, okay, yeah, that's more what investors want. The issue is a lot of times when you're looking at covered call ETFs, many make the mistake of just looking at the yield and not looking at the total return. And yield often sells. It's really
Yeah.
what people want, but it doesn't give them what they need, which is that overall total return. So, we've had long conversations going back to 2016 when we've launched, for example, Devo with advisors who maybe poo-pooed the product initially and said, I just want that 11 or 12%
Yeah.
option income product. And then we've been able to revisit those conversations and either win back some of that allocation or take over it, because at the end of the day, they like a double digit total return versus a single digit total return, even if that means they're taking a little bit less income on a monthly basis from those option income products. So there's something for everyone in the ETF space, and I would just encourage advisors to really look into, especially in the option income space, not only the income that's being generated, but the total return over a several year multiple, because that really starts to differentiate the approaches. Again, our approach with Devo and iDevo, they're actively managed products. And yeah, they use covered calls, but they're tactically written. So at any given time, we may have 25 securities in iDevo, and you may see only 3 or 4 option contracts
Hmm.
being written. So this isn't a product that, as many indexes do, robotically every month cover the entire portfolio and then limit your upside. Instead, it's done by managers who are going in and out, writing options, just like many financial advisors who use options or covered calls in their practice would do. It's a lot of work, and that's why many advisors don't do it. And for us to be able to offer a fund that does do it, either in the U.S. or internationally, at a we think attractive price point, less than 60 basis points, we think makes a lot of sense. So another set of solutions we have at Amplify that I think can add some value, especially during trying times in the market.
Yeah, for sure, for sure. You brought up alpha. Last thing here, you brought up alpha and trying to find alpha during times of uncertainty. What are some other maybe sectors or asset classes that financial advisors may be able to locate alpha during this time of, I don't want to say chaos, but chaos?
Yeah, yeah, no, it's a good point. Certainly long-term returns for asset classes are likely to be challenged here, or maybe not as robust as we've seen over the last 10 years if the forecasters are right. So, we certainly have a variety of kind of concentrated funds, whether it's thematic or just kind of growth funds that we think have some great potential. One that's standing out this year is our cybersecurity ETF hack.
Okay.
As you know, cybersecurity is kind of an interesting theme because it intersects this area that's growing rapidly because of digitization, AI, et cetera. But it's really also become more like a utility. Companies, governments, consumers, you can't really afford to cut your cybersecurity budget because if you have an incident, it could be massive in
Yeah.
terms of its cost and its liability. So cybersecurity kind of has a unique blend of defensiveness, but also growth prospects. And this year cybersecurity has outperformed the Nasdaq 100 nicely. Cybersecurity doesn't have as much Meg 7 exposure, so that explains some of it. But also, we think kind of the demand there is fairly consistent. The last kind of area that also kind of benefits cybersecurity is these geopolitical tensions. As you know, a lot of these countries are kind of throwing their elbows out, not with necessarily artillery, but with cyber attacks on infrastructure and other systems, and that's happening from adversaries as diverse as the U.S. to North Korea to even Iran. So
Yeah.
that also kind of is a underlying benefactor sorry, underlying motivator for increased cybersecurity demand and spends. Flipping the script away from something like cybersecurity, gold and silver have done quite well this year. Gold at all-time highs, silver kind of lagging at this point. Silver's a little bit different because there's a lot more industrial use for silver in, batteries, in solar power, et cetera. But there's been a huge demand shortfall in silver, and it is viewed as a store of value, maybe kind of a secondary store of value relative to gold. We have a junior silver mining ETF, SILJ, that has had some real nice returns this year. It's outperformed silver year to date, and has double-digit returns. And we think that is an area that has long-term kind of bullish setup. Supply and demand, there's an imbalance. There's just not enough supply for the demand that's there. There's a growing kind of allocation towards hard assets given all the
Yep.
uncertainty. And while gold and probably Bitcoin, depending on your view there, tend to be kind of the poster children for that, silver is probably number three, and will benefit from that trade as well. So we think that's a very interesting area. I will caution SILJ is quite volatile. You can see days where it's up 6% or down 6%, but it is index based and it does own these mining companies, which have leveraged exposure to the price of silver on the upside and the downside. And we think over kind of the course of the next few years, given some of these dynamics we talked about, that silver prices will be increasing and indeed may be able to break all-time highs, similar to what gold has done. So those are two kind of diverse areas. One kind of a tech alternative and cybersecurity hack, and then the other kind of in the hard asset area in terms of our junior silver miners ETF, SILJ, both performing well this year. So there's always some opportunity somewhere. I know somebody says that on TV. I think it's Jim Cramer saying there's always a bull market somewhere, but there are unique opportunities
Yeah.
to capture alpha, and we have a variety of different products specifically in our growth suite that really, I think, allow you to not have to decide which is the right cybersecurity stock or the right silver mining stock, and instead own a diversified product that's index based, that's rebalanced regularly, that really seeks to control the risk in investing in something that's more concentrated.
Christian, fantastic conversation. You brought, as expected, such great insight about portfolio construction, some strategies out there for people to consider during this time of uncertainty. Thank you so much for coming on the show and sharing that insight. It was really an honor and it was fun. Where can our audience get more information about Amplify ETFs?
Yeah, so amplifyetfs.com is our website. I do every 2 to 3 weeks, I do put out a video called Amplify's ETF Watch that highlights 3 timely ETFs in our product line. I think the last one I just did was the 3 products that we've had the most inflows in this year. So what the market wants. At times we also, talk about products that maybe aren't seeing inflows, but are having some great relative performance stories. So that's on our website, as well as commentary. We have active ETFs, we have portfolio managers providing monthly commentary on those. We also have index-based ETFs where we do quarterly updates. So that's kind of the home of everything Amplify ETFs,
Fantastic.
amplifyetfs.com.
I went there in preparation for our conversation. Guys do a ton of great content. Love it. A lot of research. Good stuff there. Thank you, everyone, for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our other podcasts on the Zephyr YouTube channel, as well as on Spotify and iHeartRadio. And please don't forget to subscribe to that YouTube channel and follow us on LinkedIn. Thank you and have a great rest of your week. Christian.